Everyone wants to talk about the super sexy tech stocks, but investing in industrial stocks can offer significant value for investors and still be kind of sexy. Seriously, there's even a song about a big green tractor. Don't forget, industrial companies can be the backbone of economies, providing the essential goods and services that keep the world running. So today, we're going to talk about 4 industrial stocks that might have a place in your portfolio. To that end, let's talk about the value of industrial stocks overall. For one, stability and resilience. These companies cater to our essential needs like infrastructure, manufacturing, transportation, and energy. And even during economic downturns, these sectors tend to remain relatively robust, making them a pretty reliable choice for long-term investors. Number 2, dividend income. Many industrial companies have a history of paying dividends, and I want to be privy to the divvy and invest in solid companies with low cash payout ratios. And I want that company to be able to continue to grow their dividends, and today's companies have cash payout ratios under 50%. Number 3 is global reach. Industrial companies often have a global presence, which can provide geographic diversification for investors, which can be especially important in uncertain economic conditions or when specific regions are facing challenges. The 4 industrial companies that we're going to talk about today span 3 different industries. So let's talk about the ground rules for inclusion in today's sexy industrials. For one, the dividend growth has got to be for at least 9 years. And I did make one exception to this rule, which I'll share at the end. They have to have a 5-year dividend growth rate greater than 8%. They're all beating the S&P 500 in total return in the last 10 years. And as I said, they've got cash payout ratios under 50%. Let's dive in and start with Snap-on, which is so much more than high-quality tools that line toolboxes of mechanics everywhere, as they also manufacture and market equipment, diagnostics, repair information, and system solutions for professional technicians and vehicle service facilities. They have a strong reputation of producing tools that last, and with that, a loyal customer base who appreciate that their hand tools are guaranteed for life. So let's check out the toolbox that is Snap-on. You can see here that they have a 10-year total return of 218.91%, 13 years of dividend raises, a 5-year dividend growth rate of 14.5%, and the cash dividend payout ratio is only 35%. Next up is Alamo Group, and the ticker symbol is ALG, not to be confused with the car rental business. Alamo Group was founded in 1955 and is headquartered in Seguin, Texas. They manufacture agricultural and industrial equipment, and they operate in 2 different segments, the vegetation management segment and the industrial equipment segment. They design and produce a wide range of equipment, including mowers, rotary cutters, snowblowers, and street sweepers. Looking at their overall metrics, you see a total return of 274.42%. And as a point of reference right now, the S&P 500's total return is 143.76%. Alamo has offered 9 years of dividend raises, has a 5-year dividend growth rate of 14.87%, and their cash dividend payout ratio is only 12.81%. Our third industrial to grace the list is none other than Caterpillar. The ticker symbol is CAT. They are a global leader in manufacturing, construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. And this is a company with a pretty well-established global presence, product diversity, and a pretty extensive dealer network. The company's reputation for quality, reliability, and innovation in heavy machinery creates a pretty wide moat in the construction and mining sectors. Looking at their metrics, you can see that they have a 10-year total return of 277.05% and have been raising their dividend for the last 30 years. The 5-year dividend growth rate is 8.8%, and the cash dividend payout ratio is 29%. And finally, the big green tractor, the Deere and Company. The ticker symbol is DE. They're commonly known as John Deere, and they are a renowned manufacturer of agricultural machinery, forestry equipment, construction machinery, and more. They've got a really strong brand presence and a global network of dealers, which gives them significant competitive advantage in the agricultural sector. Their focus on advanced technology, such as precision agriculture, positions them as an industry leader. They've been providing a dividend to their shareholders for 33 years, although have only shown 2 years of dividend increases, which I'm going to show you a little bit more about in just a second. But check out the total return, 469.99% in the last 10 years. The 5-year dividend growth rate is 14.38%, and their cash dividend payout ratio is under 50% at 49.42. Now let's take a closer look at the dividend history for Deere. Now, as I said, they've been providing a dividend for 33 years. You'll see that in 2014, that dividend was 60 cents per share, which continued all the way until September of 2018 when they raised their dividend to 69 cents a share. Fast forward to December 2018, and they increased the dividend again to 76 cents a share. But then they kept on paying that 76 cents all through the pandemic until March of 2021 when they raised the dividend yet again to 90 cents per share. And you'll see here that in the last 2 years, they've raised their dividend 6 more times. So what do you think? Do you have any of these sexy industrials in your portfolio? Or perhaps one of them is on your watch list? Leave me a comment below and then go and take a peek at this video next.